Hello, internets. Do you live in a world of metals encrusted with snails? Why not? We do. There are snails encrusting metals. It looks nice. And the wind cried, halving. What do I mean by that? The wind, the noise of the peanut gallery. The incessant volleys of nonsensical gibberish. That's what. Hey man. Hey, what up, buddy? All of that insane noise. It's really quite something to behold. I mean, the amount of absolutely insane misinformation and disinformation that people buy into when they are trying to understand how does the Bitcoin halving or the Litecoin halving or any other coin that has a halving, but specifically the Bitcoin halving, how it affects the coin and if it will affect the price of the coin. It's almost funny if it weren't going to go and wreck so many people. Now, why is it that people will get wrecked at or around the halving? Well, first of all, in trading, people are always getting wrecked. Not just because of the halving, right? Let's keep that straight, transparent. People are constantly in over-leveraged positions that are getting them wrecked. Right? On a typical day, in the last week or so that I looked at coin glass, for example, each day, once a day, the average number of people trading crypto across the markets that it tracks, the average number of people that got wrecked trading crypto in a 24-hour period was around 90,000. 90,000 people each day. In some cases, positions as high as, I think I saw one, somebody lost $10 million in a Bitcoin trade. I saw a couple times people lost Ethereum and position amounts of around 8 million and 6 million. And each day we're talking anywhere from, on a low day, like $100 million, right? And there were, there was at least one day with $250 million loss overall in the crypto market, right? When I say loss, I mean people getting liquidated. That is just absolutely horrible. And those people, retail traders, institutionals, whatever, hedge fund managers who don't really know how to trade, but they think they do, they have been very carefully misled, misinformed, disinformed, lied to believe the nonsense that these charlatans call themselves technical analysis gurus and constantly shill links to the exchanges that they have affiliate links with very carefully programmed to believe that nonsense. When in reality, it has nothing to do with that nonsense whatsoever. As you know, if you watch my videos, what does matter in trading is the volatility, the entropy, the probability, and the statistics, which together form the nice little acronym VEPS, and that's what we call it at Alpha Trading. And yes, you can learn the VEPS for free at Alpha Trading. Just go to alphatradinghq.com/discord, and when you're in there, it's free to join. It's free to join the Discord for that access. It's free to request the free volatility starter pack of indicators and the free pre-populated chart that you get, and learn how to actually trade volatility, probability, and statistics correctly with the free tools that you get from us, and they're yours to keep and to use as long as you are a free member or a member of the Discord. As long as you don't exit the Discord, leave the Discord, right? Like click the leave the Discord button. Now, why do we do that? Why do we give out all that information for free? For one very simple reason. We are sick and tired of seeing people get wrecked because they use garbage information. Like, the Bitcoin halving is going to cause the price to double within a week. Oh, really? That's what you think? You think because the Bitcoin halving is going to cut the supply in half every halving, the price necessarily needs to double this time in a week or 20 days or whatever? If that's what you're going on, and you're not actually looking at the VEPs, then you're going to be in for a very big surprise, I guess, when it doesn't do exactly that, right? How about you look at the actual information? Right? Don't try to figure out, well, the last few times I did this, it was an average of 18 days until it doubled. Okay, well, that's not real technical analysis, I'm sorry. Do you know why? Because patterns break, math doesn't, right? Especially when it's highly relevant math. And when I say highly relevant, I mean relevant to trading. Because that, of course, is what we're talking about, right? Not just random maths. The highly relevant maths of trading, the means, the returns, standard deviation of returns, the entropy, the variance, the divergences between the returns oscillator and the price action, or the alpha laser returns and the price action. Right? All kinds of things. Relevant maths that the big boy bots use over at the HFT firms and at the quant shops who build the big bots for themselves and for clients. So, do I think that the Bitcoin halving will cause the price to spike? No, I don't. Because that's not a relevant math to trading. Is it relevant to the overall amount of supply and demand? Yes. Does that ultimately, on a macroeconomic level, affect price? Sure, you can argue that supply and demand affects price. How does that help you in this minute? Because it doesn't help you in this minute when you're actively trading, right? It's irrelevant. Yeah, it's a nice macroeconomic factor that you can say, oh, sure, supply and demand matters. Yeah, it does matter. But it's a macroeconomic picture that affects the big picture. It is not something that affects the tiny little details, the minutia of actually trading, right? The relevant maths that really matter, as I've gone over before. So, will the halving fix the price to go one way or the other? No, it's not about the halving. The halving will just cause a supply shock for a demanded, a product that is in demand and for which there is a fair amount of liquidity compared to other markets, right? Certainly not the biggest market. So, is the price likely to go up because of the halving? Again, completely moot. On a big picture scale, you could say yes, over time, price is likely to go up as long as there is a continued demand for it and people keep buying it at the prices they're buying it at and higher. But if people don't, well, there's only two kinds of pressure in the market. There's buy pressure and there's sell pressure. Either people are buying the product at a certain price or they're selling it at a certain price, right? There's only buy pressure and sell pressure. There is no other kind of pressure on markets. All the other stuff that people measure are measurements that derive from the buy pressure and the sell pressure, right? And orders on the book that are not yet executed, like spoof orders or even real orders, yeah, they do move the markets in the sense that people chase them. But the people who chase them with actual orders are putting the actual pressure on. The spoofers are putting virtual pressure. That's not real pressure. It's fake, but it's the ones who chase them who do put actual pressure, either buy or sell pressure, depending on which way the spoofers are going. If you don't know what a spoofer is in an unregulated market, well, let's just say, to put it very simply, there are no rules in the unregulated market, really, even if you have to do AML, KYC stuff, KYC, AML, right? What you have to realize is the markets themselves are allowed to allow people to spoof orders on the assets, and they do. And some will tell you they try to limit it, this and that, because in a regulated market, spoofing is not allowed, right? Hoax orders are not allowed, but they still happen. But when they happen a lot, they usually get shut down pretty quickly. And the people who do it can be punished, even quite severely. But in an unregulated market, guess what? It happens all the time. And the spoof orders don't mean anything. It's only people who chase them that it means something to. So, don't fall for the noise. It's just noise. Don't just believe the hype that the price is going to do this or that because somebody that has a lot of followers on YouTube said so. That's not how markets move, okay? Yeah, sure, can an influencer cause a tiny little new asset to have a pump and then a dump? Sure, because if his following is bigger than the amount of people who are actually trading the asset, and all of the actual traders for that new asset come from his or her following, then sure, we've seen that a lot, right? Like, who was it? BitBoy was infamous for doing that kind of thing. He would tell you to buy something, and then like within, 6 hours after you bought it, it would dump. So the trick was to know when to buy, which was like usually within 3 minutes of when he would say it, and then to dump it like as soon as it spiked, which is what most people did. But, well, most people who were not getting their, positions wrecked, and the actual bulk of the people did get wrecked because they would buy it thinking it would go up and keep going up, but of course it went up and then crashed, and that's known as a pump and dump. All right, don't be fooled by people giving you pump and dump information. Don't be fooled by people shilling you garbage information about what they call technical analysis, which is not technical analysis. It used to be called it maybe in the 70s, up until the 70s, but ever since the late 70s, early 80s, all that garbage technical analysis that people used then is now just garbage information that's useless because it's nothing more than a pile of lagging information, and you can't do anything with it as a trader except lose money. And the people that push that information down to everybody that pushes it on to people like you and me or whoever, well, I don't use it, but us retail traders, they're the people at the top firms who would never touch it with a 10-foot pole. But then you're putting in smoke and happy trading.